How to trade the supply and demand trading strategy in 20 minutes or less. That's what we are going to talk about today. I've been trading this strategy for over 10 years now, traveling and trading around the world, and now helping traders become consistently profitable in 90 days. And in fact, at the end, I'm going to give you a bunch of resources and the blueprint about how to become a profitable trader in 90 days. We're going to cover everything in this video. What is the theory of supply and demand? How to identify, draw, trade these supply and demand zones? How about entries, exit, take profits? We're going to talk about 3 setups. We're also going to touch base on the importance of identifying trend, because it is extremely important. We look at traders who come to me and time again they say, look, my trending markets perform a lot better than my counter trend markets. My quality trades perform a lot better than my non-quality trades. So it's important that we identify quality zones. We're also going to touch on journaling and a proper review process. Very good video. It's going to be jam-packed, 20 minutes. I appreciate if you guys like the video, subscribe, and if you have any questions, you can reach out to me on social media at MoneyballAustin, and you can drop the question down below about this methodology. Let's get straight into it. So the first thing that you need to understand is that there is no best trading strategy. There are many different trading strategies out there, but it's important that you find one trading strategy that makes sense to you and you master it. For me, it's been supply and demand, been doing it for over 10 years, but you can always add little things from other trading strategies into your analysis. The second thing, this is going to work for all different markets, whether you're trading Forex, crypto, futures, stocks, whatever other markets that are out there, this is going to work for those other markets as well. I know a lot of people are going to come to me, what is the best time frame sequence? Let me break this down to you, because there is no best time frame sequence, because not everyone is here to be a day trader or a swing trader. If you want to do long-term trading, this is probably something you're going to be looking at. If you want to do day trading or scalping, these are the time frames that you're going to be looking at, all right? Using the 4-hour or the 1 hour as your highest time frame. You can still use 30 if you want. All right, there's nothing wrong with that, but these are rough guides of time frame sequences that you want to use depending on the type of trader you are, okay? Number 3, the whole theory of supply and demand. It is to identify where the big money is buying and selling at and trade with them. All right, we understand the big money, the institutions, they move the market. So it's important that we are able to identify where these institutions are buying and selling at. Luckily for us, they leave footprints in the market. So these very strong imbalances that you see on a chart going down, or in this case going up down here, from these strong imbalances, this is billions and billions of dollars moving the markets. So these are the type of areas that we want to locate on the chart. Luckily, like I said, they leave footprints, and these are the 4 patterns that we trade. The 4 patterns that we are going to be trading, we have 2 supply zones and 2 demand zones. Our supply zones are going to consist of a rally-based drop, how it rallies up, it bases, and it drops. We have a drop-based drop where prices drop, base drops. Those are our 2 supply zones. And our 2 demand zones are going to be a drop, base, rally, and a rally, base, rally. Okay, those are the 4 patterns. Now note, the reversal patterns, which is typically known as the rally-based drop and the drop-based rally, tend to be higher quality than the 2 continuation patterns, which is the drop-based drop or the rally-based rally. We will talk more about this in depth, but those are the 4 patterns that we need to be looking for, okay? But how do we draw them out, okay? Because we need to go to a chart and locate them. Like I said before, these big money, the institutions, they leave footprints in the market, all right? Clearly, they saw value up in here before, up at this area, before it had this massive drop to the downside. There was a lot of value that they saw up in here. That's a big sell-off. So what we're trying to think is, if they previously saw value up there before, once prices arrive back into this area, will they see value in it again? And that's when we want to start trading. So if we have a supply zone up there, how do we draw it? Okay, you're going to notice there's 2 things to these patterns. There is strong imbalances, very strong imbalances, and then there's base. The base is where we want to locate to where we draw our proximal and our distal line. So if we're going to highlight the base, this is what I want to do. For this supply zone, I want to take the average of the base Okay, I want to highlight the base. I'm not trying to nitpick saying that's the supply zone. I'm not trying to say that's the supply zone. I'm trying to get to the origin of where the imbalance originated from. Did the imbalance originate from down here, or did it originate from up there? It originated from up there. So that's where I want to draw my proximal and my distal line. Your eyes want to gravitate to strong imbalances like this. So we're going to draw our base like that, highlighting the top 50% candlesticks with our top of the line going at the top of the wick for supply. All right, but notice how I'm not going like this. I'm highlighting the base of where it originated from. This is where the imbalance originated from, so that's typically where I want to do it. Same thing for demand. So if this was my demand zone, I would highlight my base like this. I would probably extend it just a little bit lower to include that wick, but I'm not going like this. I'm not ignoring the bottom wicks. You don't want to do that. That is how we draw out our supply and demand zone. Now, there are supply and demand zones everywhere on this chart, but we want to be selective on how we identify certain zones. And this is a very important concept that we need to talk about, is what makes a tradable supply and demand zone. Every zone needs to accomplish at least a 2-to-1 imbalance within the first 3 candlesticks. If prices don't go at least 2-to-1 within the first 3 candlesticks, I do not want to draw out that as a supply or demand zone. How do we measure that? Okay, this would be my base. Like we talked about, that would be the base. The total measurement is 1700. Well, I need the imbalance to go at least, I don't know what my math is, like 3500, right? So the imbalance candlesticks need to go at least 3500, something like that, within the first 3 candlesticks. Well, in this case, within the first 3, it's gone like 4-to-1. So that is a good zone, all right? Same thing with these 2 zones over here. The base consists of 800. Within the first 2 candlesticks, it went 2000. Onto that, we want prices to actually remove an opposing zone or break momentum line. So in case, with these imbalanced candlesticks, it needs to remove an opposing area. That makes it a qualified zone. So in this case, with those imbalanced candlesticks, it removed that zone. This zone over here was removed. This zone over here was removed. That makes it a tradable zone. Okay, so we need prices to go at least 2-to-1 and remove an opposing zone. Okay, it also helps if it breaks momentum line, which also makes it a tradable zone. There's 3 things: goes 2-to-1, removes an opposing zone, and or breaks momentum line. All right, but guaranteed 2-to-1 zone is a must, guaranteed. Okay, because it's extremely important that we are identifying these strong zones. Once again, entry time frame, quality setup. You can clearly see that there's a difference between a quality setup versus a non-quality setup. Good setup versus average versus poor. 2 wins, 5 losses when he's trading a poor setup versus if he's trading a good setup, 11 wins, 5 losses. So it's important that we qualify these zones as tradable zones. Step 6, we need to be able to identify trend lines and trend assessment, because trend is extremely important, because there is a large difference between our winners and losers. Sideways with the trend or in a sideways market, 19 winners, 7 losers. Versus if he's trading counter trend, 6 winners, 9 losses. Same thing for this guy over here. When he's trading with a trend or in a sideways market, he's got a 68% win rate versus trading counter trend, 30% win rate. So it's important that we actually have a method of determining trend, okay? Thing is, there's a million different ways to determine trend in the market, okay? So after the first thing that we do on a chart, is we identify our supply and demand zones. The second most important thing is that we determine the trend. Okay, like I said before, I just explained why it's important. So when we go to a chart, we need to also determine the trend. Okay, how we determine the trend, there's so many different ways. Some people will use moving averages, some people will use Elliott wave theory, some people will use higher highs, higher lows. What's important is that you are consistent with this approach, okay? So the ways that we will determine how to determine an uptrend or downtrend, an uptrend is if we are removing opposing supply zones and creating higher highs and higher lows, versus a downtrend is if we are removing opposing demand zones and we are creating lower lows and lower highs. So in this case, we would be removing opposing demand zones and creating lower lows and lower highs. All right, so that would be a downtrend in that case, and it's extremely important that how we are determining trend. This is a very important concept, and this was my light bulb moment in trading. You need to understand that trend turns from inside out. What do I mean by that? So if you have, let's say for example, a 4-hour supply, let's just imagine up here is a 4-hour supply zone. If you have prices coming back up here to a 4-hour supply zone, the trend on a 5-minute, the 1-minute, the 15-minute is going to be in an uptrend. As it's going up into a 4-hour supply, it has to be in an uptrend on smaller time frames. So that's okay. If we are going to start looking for confirmation and price turning, there's certain things that prices have to do. In order to see prices turning, we are going to have to see opposing pivot point zones being removed and trend lines being broken. So in this case, if we have prices going up into a 4-hour supply, we are going to see 5-minute higher highs, higher lows. In order to see this thing go from an uptrend to a sideways market, the first thing that we are going to see is we are going to see upward trend lines being broken and opposing pivot point zones being removed, 5-minute demand zones being removed. That is confirmation. All right, that's a very important concept. It changes your trading altogether. I could break down the stats for you, but I've already been doing it. It's extremely important that traders understand this, that this is how prices turn, okay? Prices turn from inside out. So that's what we want to be doing. We want to be waiting for prices to be trading with the trend maybe, or trading inside a higher time frame zone, and then go down to a lower time frame and look for our entry. We don't just trade straight up at these zones. Let me break down a trade review. And in fact, let's just start talking about the top-down analysis. All right, because I want to talk about the large majority, but I'm probably already 10 minutes into this. Top-down analysis. Let's talk about the multiple time frame setup. And this is going to be Euro Swiss. Let's talk about a losing trade setup. Okay, so this was a setup the other day that we were talking about. The first thing that we do, okay, when we come to a chart, we draw out our supply and demand zones. So before we had a very nice 4-hour little supply zone right here. All right, little drop base drop, strong imbalance to the downside going at least 2 to 1. It removed an opposing zone. That is a good 4-hour supply zone. Okay, so when prices come back into that zone, we want to start looking for selling opportunities because this is previously an area where big money took control. So prices come back up into our higher time frame supply, and we start going down to a smaller time frame. Okay, so in this case, I think it was a 30-minute time frame. And you're going to notice as it's going up, higher highs and higher lows. That's what we want, all right? But we need to see confirmation, all right? We need to see break in structure and opposing pivot point zones being removed with momentum lines, okay? That's what we need to see. Some people will talk about this maybe in a bit. Some people might be seeing this as confirmation. I might say, going back to lesson 1 when we started talking about this, we want this to occur within the first 3 to 4 candlesticks, right? We want the zone being going at least 2 to 1 within the first 3 candlesticks. It looks like this zone did it. But we also want the opposing pivot point zone being removed and momentum line being broken within the first 3 to 4 candlesticks. So in this case, it's taken 1, 2, 3, 4, 5. It took 6 candlesticks in order to get all of those candidates for what a tradable setup is. So that's not something I would want to trade, okay? But this over here, notice the difference between this setup versus this setup over here. Highlighting my zone. In this case, we would have broken upward momentum line, okay? Removed the opposing pivot point zone, but everything was accomplished within 3 candlesticks. This is a type of trade that I would want to take versus the other one. All right, and time again, when I look at my trade reviews, and we'll talk about them, rally base drop supply zone, broke momentum line, removed the opposing pivot point zone, all within 3 candlesticks, right? It's not taking 10 candlesticks, it's not taking 6, it's happening very quickly. Okay, so that's what I want to see. Let's talk about entries and exits, because before, yes, this was a setup. Where would you enter on a trade setup like this? Okay, price inside a higher time frame zone, We got confirmation. We want to go short. Okay. I am going to enter my short back here at the proximal line of where my base originated from, right here. Okay. That's where I'm going to get filled on the pullback right there. All right. Not up here, not down here, but here. That's where I'm going to get filled once prices go back into my zone. Okay. That is your entry. Your stop loss is going to depend based off of, is it going to be a structure stop loss, or is it going to be just a random volatility based stop loss? Because we never want to place our stop loss right above the zone, like right there. We don't want to do that. Can you see that little green line? You don't want to do that, right? You want to place it above. An example of this, a volatility based stop loss, and I just want to have it generally below. So this was my zone down here. If I had it right here at my distal line, I would have been stopped out. You want to create some type of separation without making it too large, all right? In my opinion, you never should really have the zone more than 1-to-1 the size of the base. Okay, this little supply zone up here, I was selling the pullback back up into here. Notice my stop loss, okay? Why did I place it there? Because I look over to the left, there's a clear structure pivot point up there. So I would want to have it right above that area, not directly above my zone. This is my little supply zone. I have it above this area, right? My distal line's up there. That's where I want to have my stop loss, okay? I don't have it 20 times the size. I'm not going for a negative reward to risk. I want to have it slightly above, okay? So that's where you want to have your entry and your stop loss. What about your take profits? Because this is a very debatable thing. So many people are different on this topic depending if they want to go for a 1-to-1, 2-to-1, 3-to-1, or whatever. What I like to do is I like to go for a minimum 2-to-1, okay? My first take profit will be at 2-to-1, and then I will move my stop loss usually by then already to break even or slightly below break even. I want to protect myself. And then I'll get out maybe at the opposing structure point for a second take profit. So let's look at a trade. So in this case, this was my long trade setup. So I was getting in long, I got in, it looks like I got out at like a 1.5-to-1 up here at opposing kind of structure resistance at this point. So that's where I wanted to manage my first take profit. And then my second take profit is like, hey, let me go for a 4-to-1 or 5-to-1 to really hit the home runs, because it's a bad feeling when prices only go 1-to-1 or 2-to-1. I know it sucks, right? My second take profit is going to be at like 4 or 5-to-1 up there, which is also an opposing zone up in here, okay? So that's where I'll have my second take profit. Now, when it comes to trade management, all right, very important topic. I will tend to move my stop to, I don't necessarily move it straight to break even at a certain time, but I'll move it based off of structure. So let me share with you an example. So in this case, I was getting short here on this zone, right? I was getting short right here, short right here, stop loss above there. It got me in. This is where I had my original take profit. It did not hit my take profit, but it's the worst feeling when it just misses your take profit, then reverses and stops you out. So at this point, once it, starts going right here, I'm probably going to move my stop to at least this period right here. All right. And then once I notice it just missed my take profit, that's when I'm going to move it to break even, because I know if it reverses, it's a high probability that it's going to continue in that direction and probably stop me out, because normally I want this thing to take off in my direction, right? But what's important is that you journal the trades and that you can review to see what makes sense to you. Because if you aren't journaling your trades, you're never going to learn from your losers or your winners about how you can best manage the trade. Man, I killed that discussion talking about entries, stop losses, take profits. Really good. Trade management too. Fantastic. So let's talk about now. We're going to dive into several other examples. I've probably already gone past 20, but screw it. Multiple time frame versus the one time frame versus confirmation 2.0. All right. So let me show you a little picture of what this looks like. Once again, this is how confirmation moves, goes from downtrend to sideways to uptrend, right? We want to locate when price is starting to turn. It's not taking 20 candlesticks, it's taking 3 to 4. That's what I want. So this is the picture I want to share. The multiple time frame setup is when you have over here prices going into higher time frame zone and you have confirmation on your lower time frame. Price making lower low, lower high, strong imbalance. But look, every zone with the multiple time frame is going to break the momentum, remove the opposing pivot point zone, pivot, not just an ordinary zone, but an actual pivot area, and a strong quality zone is being created. What is a strong quality zone? Price is going over 2 to 1 within the first 3 candlesticks. Price is breaking the momentum line, removing the opposing zone. These are all things that I require on my entry time frame. Okay, guaranteed. That is the multiple time frame setup. We then talked about, we didn't talk about it here, but then we started discussing about one time frame. Let me break down to you what the one time frame setup is. The one time frame setup is when we don't necessarily need prices inside a higher time frame supply or demand zone, but we must trade with the higher time frame trend. Okay, this was a trade example, USD Mexican. When it comes to this one time frame setup, everything is going to be the exact same, but I don't need price inside a higher time frame supply or demand zone, but I must trade with the higher time frame trend. I must trade with the higher time frame trend. So I notice price in an uptrend, I'm looking for buying opportunities. These were the two setups that we were talking about in the group. All right. Once again, you're going to notice these two setups. Look at this demand. They all are going to look like this, higher time frame in an uptrend, but we're going to have this short term, lower low, lower high, pivot point zone being removed, strong quality zone being created. Right? Once again, this demand zone, prices never came back, but it was on the watch list. Strong imbalance, removing pivot point zones, tight base. Same thing up with this one. All right? Lower low, lower high. We could draw that downward momentum line, connecting it to the pivot points. We have that very strong imbalance. Once again, first 2 candlesticks went over 2 to 1. It removed opposing zones and it broke momentum line. That's what we want. You'd be entering here on the pullback. How would I manage my entry? I would have my entry right here, sitting at my proximal. I would probably have my stop loss right around here, most likely. That's where I'd have my stop loss. And then my first take profit might be 1 to 1, 1.5 to 1, maybe 2 to 1. So say maybe up here. And then my second take profit maybe at 4 to 1, 5 to 1. Okay. But how I'm going to manage this trade, once it made this move up to here, I'm going to move this stop loss to this. I wouldn't necessarily move it to break even. I would move it right below to where it previously went into. Because chances are if it goes back into my zone from this area on, it's going to remove it altogether. Okay? But there's a lot of the times where we'll pull back, test that area, and then blow up to the upside. So that's why I want to have it there. Okay? But once I get my first take profit hit, I'm moving that sucker to at least break even. Okay? It's risk off, risk free. I'm shooting for the moon. I'm hitting that home run. That's where you get paid with the multiple take profits. Okay? But that is the one time frame setup. Let's go over 1 or 2 examples. Gold. I know a lot of people have sent me this message on gold, and a lot of people caught this. Higher time frame gold, one time frame short. Downtrend, right? So if we're in a downtrend market, we could say, hey, I could look for one time frame setups to the downside. I don't need price inside higher time frame supply, but I need to be trading with the trend. I want to look for a quality setup. He went down to his lower time frame and he had this strong quality zone right here. Short term, higher high, higher low, boom, right? It's the same thing I've just been drawing out, guys. It has to look like that. It's not taking 10 candlesticks. It's taking 3-4 candlesticks and it's accomplished all this. All right. He trades the pullback. He's also reacting off of like a moving average, right? That's how he's trading it. All right. He's got his proximal, his distal line up here. He's got his stop loss up there. Okay. He gets filled into his trade. Once again, it's the same damn setup. He's trading with his higher time frame trend in a downtrend. So he doesn't necessarily need price inside a higher time frame supply. And so he looks for one time frame shorts, right? That is a valid setup. It was the same thing with the USD Mexican we just trade. And now we also have a second setup, which is kind of the confirmation 2.0 setup. That is basically when you have, say for example, here we had prices going back into this rally-based rally. Once again, guys, rally-based rally, proximal distal line, tradable zone, gone over 2 to 1, removed opposing zone. Everything happened within the first 3 candlesticks. So that is a good higher time frame zone. I am not trading straight up at these higher time frame zones, okay? Prices go into higher time frame demand. I go down to my lower time frame to wait for confirmation. Looks like we had lower low, lower high. We had some type of maybe confirmation down here on a smaller time frame with maybe a stop down there. Anyways, this was the confirmation 2.0. Say prices go into your higher time frame zone, that's confirmation 1. But if we don't get the pullback and prices continue to go down, that is what is known as confirmation 2.0, and you would trade this as the setup, right? So in this case, we had the break, we kind of had this higher high, higher low, right? Okay, once again, this zone going over 2 to 1 within the first 3 candlesticks. It's removing opposing pivot point zones, and it's breaking momentum. It's a great zone, okay? We trade the pullback back in here, and it looks like I was having my take profit at 2 to 1. I had my original stop down here as a structure-based stop because of down here to the left. And what I did, prices went up, looked like it went 1.75 to 1, and then it reversed. But I got stopped out here because I moved my stop up just below break even at that point, okay? That's how I'm managing the trade, and that is the confirmation 2.0 setup. So if we look, multiple time frame confirmation setup, prices go into higher time frame supply, okay? Higher high, higher low, boom. Break momentum line, opposing pivot point zone, strong quality zone being created. Once again, I need all of this circled right here. The 1 time frame setup is when you're trading with the higher time frame trend direction, and so you don't necessarily need price inside a higher time frame zone, but you go down to your lower time frame and it's the same damn setup, but you need it to break, the opposing pivot point zone, break momentum line, and that is your zone, right? And then you trade it once price comes back up. You're not chasing price, you trade it once it comes back up, stop loss above there. You know how to take profit, trade management, you know all that, right? And then the confirmation 2.0 setup, let's just say this is our demand. We have prices going down. That would be our confirmation 2, or confirmation 1. Confirmation 2 is like it misses your entry, but it continues to make new pushes or new higher highs or new lower lows, right? Depending if it's a buy setup or sell setup. But once again, it has to move at least 2 to 1 and make a new higher, higher, higher low, right? Or for supply, lower low, lower high, right? But notice they're all drop-based rallies or rally-based drop patterns for my entry time frame. And if you want to add indicators or other technical analysis, that's totally fine. This is a really good supply zone up here. Went over 2 to 1, very strong in balance, but notice it's removed this zone, it's removed this zone, it's done all this, but it's broken through a very clear support. So you're going to have support and resistance traders, you're going to have supply and demand traders, you're going to have breakout retest traders shorting up here, and you're going to have traders kind of trading this 200 moving average as it's coming back up. You're going to have traders trading that, right? So once prices go back into that zone, I would consider looking for selling opportunities. Just because you have all these things doesn't mean necessarily it has to be a winner, all right? Get that out of your head. It's important that you understand that. But if you want to use indicators, chart patterns, other confluences, I do too. I use it, but it's confluence to the trade setup versus if it didn't do those other things, right? It's important to have a trading plan, all right? This is a very easy step-by-step process. This is something that I did early on. I created a mind map. Early on, this is many years ago, this would help me determine a trade setup, right? And so the first thing I would do is, okay, step 1, what do we do on the chart? We identify our supply and demand zones, all right? That is step 1. Step 2, I determine the trend, all right? After that, I can start following this mind map. Is price inside a higher time frame zone? No? Okay, no trade, next chart. Yes? Okay, can we set and forget? I no longer do set and forget. So let's skip it. So let's go wait for confirmation, all right? Has price shown confirmation? Broken momentum line, remove pivot point zones, whatever? No? Wait for confirmation. Yes, it has? Okay. How does it score? Is it a good setup? Yes, it is. Okay, take the trade. So you follow this mind map around to be a good setup. And you could extend on this to be like, are you trading with the trend? Do you allow yourself to do a 1 time frame setup? You know what I mean? That's definitely something that you could add to a mind map like this and create your own, right? Because everyone's going to trade a little bit differently, but very easy. It's actually very easy once you just understand the basics, right? So make sure you have a trading plan. So another thing I wanted to quickly touch on is the pros and cons of trading multiple markets versus 1 to 3. Okay, I personally focus on 1 to 3, but let's quickly go over it because it's a very important topic, because people come to me asking this all the time. If you decide to take 1 to 3, the pros and cons, you are going to learn those markets extremely well, and you're going to learn how those markets trade during certain times of the day and how they move. Okay, it's going to be a lot less stressful in your trading when you're only looking at 1 to 3 markets versus 30. Okay, just understand that there is a potential for less trade setups as a trader, and if you go a couple days, 3, 4, 5 days, you are start going to panic in your mind thinking, oh, I got to take trades, I got to force trades, and you're going to have FOMO. That is potentially what might happen. Versus if you trade 20 markets, you could be very picky with your trade setup and what a quality setup is. Okay, you can cherry pick them, but just keep in mind you won't deal with FOMO typically, but you'll deal with information overload. You're going to be looking at 20 different markets, 20 different pairs, 3 different setups, right? Different time frame sequences. It can be very overwhelming. Just make sure you know that you can always add or remove, okay, these types of markets. So that's important, depending on who you are. So the other thing I wanted to quickly also touch on is reviewing. All right, it's important that we journal and review our trades. This is what separates a break-even trader versus a losing trader, okay? This is something I said to the private group when we're coming to the end of the year, and so this is what I say. I expect everyone here to do a year-end review. Reviewing is one of the most important things a trader can do, especially heading into 2024. As a trader, we need to be constantly adjusting our trading strategy and adapting to new markets. This is why we journal our trades, good or bad, as it will become a learning experience and help us create a better edge for ourselves. This is what you should do. Get a piece of paper and create a ticker tally sheet and analyze everything that you can determine. What is your win-loss percentage if you were trading in an uptrend versus downtrend versus a counter-trend market? Win rate when trading a clean arrival versus poor arrival? What is the win rate between the one time frame setup versus multiple setup? What about if you went for 2 to 1 versus 3 to 1? Or what happens if you get out at 1 to 1 versus 5 to 1? How does that affect your win loss? What about if you moved your stop to break even after a certain point? How does that affect your trading? Do you make more money? Do you lose more money? Okay, these are so many little things that you need to review to figure out. This is what you see that I was showing you, that people are reviewing to figure out what makes sense for them as a trader, okay? It's much different when they do the work and they do the trade reviews and they come up with 40 to 50 trades and I do a one-on-one with them than somebody just listening to this video, but it is extremely important, okay? In fact, there is an 1.5-hour long video covering everything I just talked about in a full course. That will be down below. Okay, I would strongly recommend checking out this tips playlist going over my trading strategy. It's completely for free, okay? But the traders that decide to work with me, check it out, moneyballtrading.com. That's where we have the goal of turning a trader to profitable in 90 days with a direct coaching. I did have an ebook going through this video. This is for the people in the private group, but I did create a free one for anybody that decides to sign up. It's completely free for this one. Register to the free masterclass and I'll send you that in an email, having a free access to the multiple time frame trade setup and a beginner's guide to this trading strategy. If you have any questions, let me know in the comments below as well. Appreciate if you guys like the video, subscribe. And in fact, if you just want to jump to that 1.5-hour long video, I will have it above my head right now. Cheers. Bye-bye.